Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about a proposal that FASB put out a few weeks ago. It's been a busy time on the Genuine Learning Blog, and we haven't had the opportunity to really take a deeper dive into this one. So we're going to take the opportunity this week to look at purchased financial assets. Now, it's a really niche area, but it's an important area that's getting an update here. And what's really nice about this proposal is that came from stakeholder feedback. So based on some of the what they call a PIR, which is where they go back over an existing standard and say, okay, how'd it go, right? A post-implementation review. And CECL obviously is still being in the works for privately held companies, but for publicly traded companies, it's been around for a little while. And so they got some feedback and they're taking a look at, in particular, purchased financial assets and looking at the PCD versus non-PCD approach. So, as I mentioned, it's been around for a little while. This was actually issued back in June 27th. However, it's been a busy couple of weeks here. We also had some of our Wellness Week right after this was issued. And so we had quite a bit going on. So we're finally able to take a little bit of a deeper dive into this. But when we think about purchased financial assets, these could be purchased through either a business combination, through an asset acquisition, or even a consolidation of a VIE. And so as we look at this, credit loss is a key consideration when we purchase these financial assets. And so just like any other asset as we go through this, and so there is an allowance for credit loss, or ACL, that is coming out of Topic 326 for CECL. And during the post-implementation review, there were a couple of things that were identified. And interestingly, it didn't come from just the preparers. It actually came from some of the users of the financial statements. Excuse me. So investors, lenders, creditors, etc., really didn't like the fact that we had two different approaches to acquired financial assets. We had a PCD, assets that were purchased with credit deterioration, meaning they had more than an insignificant change in their credit quality, versus those that were non-PCD. And so there were two different models that were basically used here. And the accounting for non-PCD specifically was unintuitive. So there was a complaint that you would have a loss upon acquisition when something did not have any type of credit deterioration. Whereas if there was credit deterioration, there would not be a loss upon acquisition. And they're like, that's unintuitive given that we know that there's been a credit deterioration on the PCD ones. And so they found that this was not making a lot of sense. And when I've taught PCD assets, I don't teach it very frequently. I usually teach it for people who do a lot of financial institutions or lots of loans that do get bought and sold. We see this a lot with mortgages, for example. And so as a result, I don't get to teach this too often, but for those that I do, they've always kind of given that feedback that this was not super intuitive to them. And so based on the feedback that even users were not finding this very helpful for them, they decide to make some changes to Topic 326. In fact, what they do is they eliminate the credit deterioration criterion that currently exists. And so right now we have PCD and non-PCD approaches. They're going to eliminate that, and they're going to use the gross up approach, which was for PCD assets. So for not recognizing upon the purchase, you would gross it up, and then you would recognize it over time. And so as a result here, it required that single approach, that gross up approach to all financial assets that were being acquired, with obviously certain limitations. So if one of them is available for sale, debt securities has an exception here. And so the goal would be to move over to a single approach that was the preferred approach of the investors. And this would not change the measurement, the presentation, or disclosure, just obviously changing the method that we're going to be using here. Now, they didn't propose an effective date. The last few of them have not had a proposed effective date. They said they were going to take into consideration the feedback provided by users, given, for example, that private companies will be adopting CECL in December. So that's obviously something that should be pretty critical here. Now, in terms of the presentation, it would be a modified retrospective approach, beginning of the year that they adopted CECL, which would be several years ago now for publicly held companies, and it would be a cumulative effect adjustment to the later of the beginning of the reporting period or the beginning of the earliest period presented, obviously depending on the private public issue there. So we still have some time. So even though we got to this a little bit later, there is still time to comment, and comments are due August 28th. And one thing that I get from people from time to time, they said, well, I really do want to comment, but I don't want to have to write a comment letter. And so one thing that I'm going to start doing going forward, especially because FASB does a great job of this, is providing a link to a survey. You don't have to write a formal letter. You can just answer the questions in this little survey monkey, basically. So it's a little form you fill out. You can skip the ones that you don't want to. You can answer just the ones that you think are relevant to your comment, and it makes it a little bit less overwhelming. Having written comment letters on behalf of organizations, on behalf of firms, and on behalf of committees before, I know that it can be overwhelming to feel like you have to have the perfect letter. And so hopefully this will make you feel a little bit more confident in giving feedback on just the pieces that you want to as you go through it. All right, so that's a wrap on this week's blog. If you are interested, definitely let FASB know what your thoughts are. I'm interested to see. There's already a comment letter that has been received from the SIFMA, the Securities. Let's see if I can get SIFMA correct, municipal something. It's been a long time, but they have asked for an extension of the due date for these comment letters because of the filing deadlines for a lot of these organizations. So we'll see if we do get an extension of the current due date, but for right now, the due date is in August. So get those comments in and we'll see if FASB extends based on the comment letter. So thank you guys so much for joining me on the General Learning blog, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.